Well, I would forgive you actually if you're a little bit dizzy with so many shifts and turns that we've been seeing in the market since the start of the year. If we look all the way back to January, we started with positive risk sentiment. That was triggered thanks to positive economic surprises that we had. And as a result, we saw global equities surge, we saw an outperformance of cyclicals versus defensives, and we even saw growth stocks reverse some of the losses that they experienced in 2022. We then moved over to February, and then economic data suggested that inflation was coming down, but it was much more stubborn than what people would have liked it to be. And as a result, we saw a retracement in markets. Now, more recently in March, we had quite a significant turmoil in the financial sector, to say the least. And that really injected an extra round of volatility in markets. With regards to the outlook, I would basically say that the dust has still not fully settled in the aftermath of recent events. However, we do have 4 key takeaways that we have today. The first and foremost is essentially the question that you've just alluded to. Are we going to have a systemic crisis? Well, clearly there's a lot of questions still up in the air that need to be addressed, but we firmly believe that the developments that we've seen so far will not lead into a systemic crisis or a credit crunch that we have witnessed in previous years. Maybe if I elaborate a little bit more with regards to the financial crisis, the reason why we are convinced that this will not occur in the first place is essentially what we did see in these institutions was quite concentrated with regards to individual setbacks and problems that institutions had. Now, what happened was that a crisis of confidence was essentially erupted on stage, and we saw deposit outflows leave certain institutions and a lack of liquidity which essentially unfolded in the developments that we saw over there. Is this going to replicate in other parts of the financial system? Well, as I said, time will still tell, but we are convinced that it will not. And the reason is that essentially regulators identified the problem. They realized that they need to bring back confidence to the market. They needed to secure deposits at those institutions that were stressed the most. They also realized that they needed to provide extraordinary support in the form of liquidity, make it available to these institutions and to the broader sector in particular in order to avoid a repeat of such events. And we believe that this liquidity support does provide some confidence. We've seen in recent days as well. Market action has suggested that we have now come back to a certain point before the March 8th developments, right? And the reason is that capitalization of major banks is still very sound. We're much higher than where we were back in 2008, and we're also well above the requirements that financial institutions are submitted from regulatory authorities. When you're looking at asset quality as well, balance sheets are sound. We don't have NPL problems. We don't have delinquencies. So ultimately, it's all about bringing back the confidence and support. Will we see some dislocation and divergence between bigger, more robust institutions and smaller names? Perhaps, but ultimately, we don't believe that a systemic crisis will occur. I think volatility will still persist. We've got a lot of question marks in the air, whether it's related towards the financial turmoil, whether it's regards to the outlook on monetary policy, or even geopolitics and the trajectory of inflation. So there's a lot of spots out there that can still inject volatility in markets, and our investors should be prepared to navigate this turbulent outlook ahead of us. That does also offer opportunities, of course. We can take volatility to our advantage, but at the same time, we shouldn't get too carried away. We should emphasize on quality as well as diversification. I think that central banks are still not done yet with regards to their fight against inflation. If we're looking at the trajectory of inflation, we've already come a long way. In the US, for example, we had 9% inflation. We've already fallen back to 6%. right? So the fight against inflation is still there. And for this reason, we don't believe that central banks are done yet with regards to their hiking cycle. But it is worth noting that the tone of central banks has shifted. We've been seeking and identifying basically hints from different speakers. We heard it from the Fed, we heard it from the ECB. They have adjusted their tone to suggest that perhaps the pace of future hikes will slow down. And ultimately, the key message is that we're not done with hikes, but we're almost done. The peak rate is right around the corner. We believe that we're almost there, and that should provide a little bit of comfort to the markets going forward, because ultimately it was the direction of inflation and the surprises that we had on interest rates that led to the big underperformance that markets had last year. I think a lot of the challenges and headwinds that I've been covering up until now are really concentrated in the developed market world. Struggles against economic growth that can be amplified from tighter financial conditions, perhaps tighter lending standards as well in the aftermath of the recent events on the financial space. Also, sticky and stubborn inflation, elevated interest rates. These are problems that we're facing in the US, in Europe, and the UK. If you take a look at Asia, China as well in particular, you see that the direction of economic growth is going upwards after 3 years of COVID-0 lockdowns. We believe that the reopening will gain further pace, and as a result, economic growth is set to increase further. Inflation is not so much of a problem in the East as it is in the West. Of course, there are still pockets of concern, but for example, in China, inflation is not a threat for authorities, and we've seen that also with regards to monetary policy. That has not been an obstacle with regards to economic growth. So at the end of the day, when we're talking about uncertainty, when we're talking about questions with regards to the financial sector, we have to keep in mind that the exposure on the banks in Asia is very low with regards to the pockets of stress that we've seen on the developed market space. So ultimately, when we are looking at globally diversified portfolios, we believe that it is worth overweighting regions, including China, including ASEAN markets generally, which should benefit from this reopening stage, in order to make sure that we're not overly concentrated in one area of risk, that we're diversified, and we are emphasizing those areas of economic resilience.
We believe there's a very significant rationale to be invested into global investment grade bonds, but with a quality bias. Fixed income investment grade bonds have repriced. We've been having a very challenging year in 2022, and now they provide with very interesting yields in euro and in dollars. So there's a very strong market opportunity to consider fixed income investment grade bond. But as I told before, it's all about quality. So we don't want to go for any kind of segment within fixed income. We'd rather go with high quality names, investment grade, and we'd rather be cautious with high yield. Why? We believe that with long-term rates remaining high for longer, it's going to be more and more challenging for some companies for their activity, for their leverage levels, and that at some point, unfortunately, we may attend more levels of default on the yield segment. Therefore, it's safer to go to investment grade, and with investment grade segment, you're already well paid for the risk you take. We believe also there's a strong call to be made with fixed maturity portfolio. What is a fixed maturity portfolio? It's a collection of fixed income securities that we buy with a specific end date. So we know in advance the maturity of a portfolio. We don't roll the securities with an open ending fund, and it has a lot of advantages for private clients. The first one is predictability. So once you're invested in the portfolio, you know how much yield you are going to do in this investment. So for instance, in today's market condition, for a fixed income investment grade portfolio, in euro, you can reach levels in between 450 and 480% in euro. The second advantage is the management of the interest rate risk. As the fund gets older and closer to a maturity date, you are less exposed to interest rate sensitivity and there is less risk into the portfolio. The third advantage is the capability, probably in our view, to do better than cash. So we believe that at some point central banks will have to lower rates, but we believe it's not going to happen before Q2 2024. When it happens, our investor in monetary funds should expect lower yields on their cash funds. If today they decide to lock in current rates within a fixed maturity portfolio, they will be able to keep those rates until the maturity, and our plan is to launch a new fund which is going to end in September 2027 and which will enable our clients to lock in the current level of rates. In our regional allocation, we have a specific tactical bias toward equity within specific countries. And as Georgios mentioned, we have a belief that the market is currently being too pessimistic about China and too cautious. There's a strong theme to be played within China recovery. If you take what happened in most of the countries after COVID, we had a very strong recovery after the lockdown were lifted, and it allowed few sectors within the economy, and many of the sectors actually, to overperform, especially everything consumer-related, travel, e-commerce, everything could benefit from the end of COVID. So we believe, that's one of our first reasons why we like China, we believe the market is being too cautious about the impact of China reopening. We believe the COVID crisis is over, which is a great news, and that the impact on the China consumer is going to be significant. So that's the first factor. The second one is the long-term growth story for China. Outside of this reopening trend, what we see is a very strong capability to do growth and to attain high level of GDP growth in the next years. What we see right now is a reacceleration. If you take our expectation for growth in Q1, it's 2.2, but it should accelerate to 7.7 in Q2 of this year, with an overall number of 5.6 for 2023. So there's an acceleration in growth that will benefit, we believe, to equity markets. There are other catalysts. Valuation is interesting. If you take MSCI China at current levels, it trades only 11 times 2024 earnings, and it's a much lower numbers than other global developed markets. So there's a relative opportunity here. Earnings growth, we believe that if you want to make money within equities and if you want to have strong returns, you need to invest in markets and companies which are able to surprise on the upside in regards to earnings. And we believe right now that first, the earnings for China equity markets are already high. We expect 14 to 15% earning growth this year and next year. But we believe that the analysts may revise upwards those numbers. So there's a very strong catalyst here. Good valuation, good investor positioning also, because most global investors are under-allocated to China and Asia. And when this investor consider that the story is changing, they may come back very quickly, and this flow effect may impact returns for the asset class. What to do with an elevated level of volatility? We have two ways to mitigate this into our portfolio. The first one, within alternative, is to keep a focus on hedge funds. So So hedge funds have two advantages. The first one, the set of opportunities they can use for trading is higher when you've got volatility and distress into the markets. So they are able to find trades that no classic manager are able to identify. And the second one is the decorrelation. If you remember 2022, one of our challenges for our global investor was the significant correlation between fixed income, equity, and all the traditional asset class. And to build efficient portfolio, we believe it's very important to identify asset classes which are able to move in a different direction than the rest of the classic portfolio. Hedge funds last year were able to deliver some positive returns for some of the segment, especially multi-strategy hedge fund and also the one who had strategies linked to commodities. And we feel that within our diversified portfolio, it's a very interesting building block to consider. The second positioning is really diversification. With HSBC Global Private Bank, we have a breadth, very significant investment offering, and we are able to build portfolio invested on a global basis, being allocated with a lot of different country, themes, sector within equities, within fixed income, including alternative, private equity. So this diverse set of opportunities is the best way to position your portfolio, because we are never going to get it right for each of the asset class and each of the tactical bets. But if you are invested in a very prudent manner on each of those small buckets, you are going to be able to navigate this higher volatility environment and in the end to earn very interesting returns on your diversified portfolio.